Hi, I'm Taylor Pankratz with Holistic Planning, and today I wanted to talk about a question we get asked quite often right now by our clients, which is now that Trump is about to be back in office, what changes, if anything, do I need to make to my portfolio? What's going to happen to the stock market, to the economy, etc.? And so today I wanted to talk about that. I hope you stick around. So the question of what's going to happen to the stock market and what's going to happen to the economy now that Trump's getting back in office is a question that obviously nobody can really answer. Nobody knows the future. We certainly don't know the future. But what we can do is talk about what we think is going to happen to the stock market and what we think could happen to the economy and what changes, if anything, you should do to your own portfolio. And if you're a client of Holistic Planning, we've done a lot of this stuff already, prognosticating this. And this isn't a change your portfolio all up and everything has got to be switched and et cetera. This is just tweaking around the edges of what you might want to do now that Trump's in office and what he said he's going to do, plan to do, et cetera. So the first thing that I think you should really consider is normally, if you're watching this, you probably have some allocation of stock market and some allocation of fixed income. Maybe it's bonds and bond funds and whatnot. I would highly encourage people that are watching this to know what you own and why. Okay, so if you own bonds right now, not that there's anything wrong with owning bonds, it's just you need to know why you own it. Okay, if what Trump wants to do is do tariffs or do the immigration thing or do any of these things that economists think could be inflationary, then what you're not going to want to do is you're not going to want to own bonds in a situation where the Fed decides to raise interest rates to combat inflation. Okay, so again, I don't know what's going to happen. I don't pretend to know. I just can tell you that the Fed has talked about that they're going to continue to cut rates. That might happen. The economy, though, right now is going very strong. And so they're kicking the can on when they are going to cut more, to do more rate cuts. They've talked about they're going to come, but we just don't know when now. Okay. What happens is that if the Fed doesn't continue cutting rates, it's my opinion that the bond market could suffer and you could see bond values go down because a lot of the rate cuts have been priced in already. The bond traders and the bond market is forward looking and they're going, hey, if the Fed says it's going to cut rates, we're going to price some confidence of that happening into the market. So it's not 100% priced in, but there's some element of future rate cuts priced into the bond market right now. And if they don't cut rates because inflation is sticky or things that Trump does are inflationary by nature, it could be problematic for bond exposure, people that own bonds or bond funds, because bond values will go down if interest rates go up. Okay, that's just the relationship of bonds and interest rates. And conversely, if interest rates continue to get cut and go down, bond values will go up. And so you would want to be in bonds at that point. So what we're doing here at Holistic Planning is we're trying not to be the first person off the Titanic, if you will, in that I want to see a little bit more rate cuts. I want to see a little bit more of what Trump's going to do, the reaction of the economy to some of his policies before I'm confident that the Fed is going to continue cutting rates that have already been priced into the bond market. So long story short, I think if you are watching this and you have a significant amount of money in bond funds or bonds, I think it makes sense to reevaluate and go, what is my investment case for this? Because if you just own bonds because it's not stocks and you're like, hey, I just want to own something that's not stock market, there's other things out there that you should probably be investing in that don't have as much risk, in my opinion, as owning bonds right now. If you just own bonds as a way to hedge your stock market exposure, there's other ways to hedge your stock market exposure without having to bring on, in my opinion, the risk of owning bonds right now. And you would remember what happened to bonds when interest rates went up during 2021, when interest rates went from zero. In 2021 and 2022, they started going significantly up, higher than they're at today, of course, but they went from zero to, call it 5. In a year and a half, bond market went down drastically. In fact, some bond funds went down more than the stock market did. So all that being said, bonds are not risk free. And I think even owning bonds right now has a little bit more risk associated with them than what most people perceive. And that's just my opinion. That's just me. Okay. So, but if you're watching this and you want my opinion, I think bonds are a little bit, certainly long-term bonds are a little bit too risky, in my opinion, for what people should own right now with knowing what we know about the economy. And conversely, the stock market, it's almost at all-time highs. It's off all-time highs by just a few percentage points lately. And so owning the stock market right now is, in my opinion, a little risky. Stock market in general is risky, just investing in it. But since it is at all-time highs, I'm a little concerned about what if interest rates don't keep getting cut, what could happen to the stock market in that scenario. And so again, think of it as bonds and stock market. Investing in both of those is basically, in my opinion, making a bet on what interest rates are going to do. If interest rates go down, both bonds and stock market is going to do well, in my opinion. If interest rates don't keep getting cut and maybe interest rates go up because inflation comes back a little bit, then I don't think that's going to be a good thing for the stock market or the bond market. And I like to think of it as, I don't want to have both my risk on money and my quote unquote risk off money to be betting on the same thing, betting on interest rates going down, right? I would rather own something that is going to be less correlated to each other and have a little bit less risk if interest rates go up. And so I'm not saying sell all of your stock market and all of that. I'm just saying it could make sense to start to look for other ways to get stock market exposure without as much risk. Think structured notes, buffer ETFs, things like this that are out there that give you stock market exposure, but just limit your risk, but also limit your upside. If the market just goes way up, you might not make as much. But in my opinion, there's more risk to the downside than the market just blowing up on the upside. So I like the idea of maybe limiting my upside, but I'm reducing my risk to the downside. But having money that's still keeping up with inflation and not, or trying to at least, and not putting it under my mattress is, still think appropriate. And so I like the idea of maybe not having as much true stock market exposure, just dollar for dollar with the stock market, but maybe having something that has a little bit of a hedge to reduce the risk of the market pulling back, and taking my bond funds and saying, is there something better that's out there that isn't as susceptible to interest rate risk as my bond funds that I own? And as we think about the next few years of Trump, he'll probably deregulate a lot of the oil and gas things, probably cut a lot of the red tape around that. That could help the economy do really well. I'm cautiously optimistic about what Trump could do to the economy in a positive way. And so I like having exposure to the stock market and to the economy in that way. I just like to have a little bit of hedge to the downside if some of the things he does cause a little short-term pain, and it's probably not a bad thing if there's some short-term pain to be able to grow the economy a little bit more over time, because the last few years the economy has really, or the stock market has really been driven by cutting interest rates and stimulating the economy with handing out, printing a whole bunch of money, etc. But like I said in the beginning, we don't we don't pretend to know what the market's going to do. We don't predict the market. We don't day trade here at Holistic Planning. We're all about taking the information that we are consuming in real time, looking in the past and going what historically has happened, and then extrapolating, hey, what's our best guess for what we think we can expect, and then how do we navigate that for each of our clients and make it still specific to them, but to make sure that we are being proactive with people's money. Okay. I do think it makes sense to make some tweaks. We've been changing up people's portfolios for the last probably 6 months based on what we're seeing with the economy and with the stock market. Maybe you're a DIYer and you manage your own money, or maybe you're a financial advisor, maybe you have a financial advisor. I would just encourage you to figure out what's the game plan with my money and what do I own and why. And because I think it's prudent, given everything that's going on, to not just sit back and just assume that your financial advisor is awake at the wheel, okay? Because there's a lot of things that you should maybe be doing that to protect your nest egg, especially if you're a little bit older and you don't have a whole bunch of market cycles that you want to go through before you want to start spending some of this money. Anyways, hope you enjoyed this content. Reach out to us if you want to talk more. And here's to a great 2025 with the stock market and the economy.